Time for another stock review. This time we're talking JPMorgan Exchange Traded Fund and ETF, the JPMorgan Nasdaq Equity Premium Income ETF, JEPQ. That's what we're doing right now, and we're going to do a full review on this stock. We're going to cover and compare. Even though I wasn't asked to compare it, I'm going to compare it for our member to the S&P 500. We're also going to look at the chart, a back test, and the dividend payout history. We're going to do all that on this stock and decide whether it's a good investment or not. So before we start, we'd like to invite everyone to tap the like button. This is made in a members only live stream. Members can have stock reviews like this and then a video which will rank on Google and YouTube, thereby promoting the stock. So it's a win-win situation just from a minimum of $5. Pretty good, right? We're here to help and serve our members. Tap the like button, consider subscribing and be part of the family. So what is an ETF, first of all? An exchange traded fund. It's a basket of funds run by a management company for a fee, and then you can just own a bunch of stocks without having to buy individually and managing them yourself and so on and so forth. Now, what's the benefit with that? Well, not a lot, really. If you actually bought exactly the same allocation of what was in the fund, you could buy it yourself without the fees, but you've got to make sure that you manage it correctly. And every time that you have some money to spend, you've got to equally spread it across. And that's going to be a lot of hassle, a lot of stress. Imagine on the S&P 500, 507 stocks in VU. It'd be quite a nightmare to do that every time. And then you'd have to manage it as well. If one got dropped, you'd have to drop it and bring a new one in. So it's much easier to buy a basket of funds, one stock, simple, and then you can just manage it that way. It really isn't practical at all to do it individually. So because I've been asked to cover this stock, I'm also going to compare it to the S&P because it's worth doing, right? So tap the like button. Let's get straight into it. See if we can make any money on this one. We're going to look over the numbers and we're going to see if we can make money on this stock and turn the money printer on and see if all the money stacks up. We're going to compare the dividend payouts and see if this is a good investment for you. How do you do? Shall we get started? Let's do it. Let's start off nice and simple and let me show you the position there. Well, over the short period that this has been around, it's not been around that long, nowhere near as long as the S&P. Back here is when it was inception, so 2 years. But over the last 2 years, that looks like the S&P. It does. You can see the big downturn it's recently had. So I can tell you now, it's very similar to the S&P. Not exactly, of course, but it's similar. All right, let's scroll down and let's read a bit more about it. So JPEQ is an actively managed fund. So it's not passively managed fund. So I don't know yet, but I would imagine it's going to be a little bit more expensive than the S&P 500 because it is actively managed. It makes it more expensive. So I'm guessing when we get down to it, it's going to be double, triple, quadruple the price of the S&P. Is that worth it? Well, you can decide in a minute. Actively managed fund. I actually am against actively managed funds. I don't think you need them. They benefit the managers that run the funds. They make money. Remember, no ETF is ever set up to make you money. Ever. Just like when someone sells you a can of Coke, it wasn't there for you as an investment to make money from it. It was there to provide you with a service and give you something that you want. Well, people want baskets of funds. They want ETFs. So we'll do it for a fee. Well, whenever there's a fee involved, is it best for you? I have never been a lover of actively managed funds. I don't think you need them. However, this one is. So I bet you any money you like. When I get to it, as I make these unedited, I read them as I make them. But with my experience of doing nearly 300 stocks, I see patterns straight away. This would not be for me. I can tell you that for off the bat. I bet the S&P will do better, and the funds itself, the expense ratio would probably would prove that. Anyway, it manages the fund of the US large cap companies from the Nasdaq-100. So it's going to be more techie. So if you like the Nasdaq, right, you might like this. However, I prefer the S&P because I prefer the balance. I don't want to all be in tech, and even though it's very tech weighted. using ESG factors and a proprietary data science-driven investment approach. The fund also invests in ELNs in seeking income generation. The listed name for JEPQ is JPMorgan Traded Fund Trust, JPMorgan Nasdaq, la-di-da-di-da. Okay, let's scroll down. Actively managed, so you pay a fee. Derivative income, we understand that. Number of holdings, 109, so you're not as diversified as the S&P 500, obviously. May the 3rd, 2022. It's a very new fund, doesn't have history yet. Again, a downside to me. And there you go. Look at that. Technology, 49%. Now, when you only have 109 stocks and you've got 49% technology, that's half the fund. If we look at what the top 10 holdings are, 50% is made up of those few things. Apple, Microsoft, Nvidia, Amazon, Google, Meta, Broadcom, Netflix, Tesla, Costco. Now, you see where I'm going with this. I wouldn't bother paying the management fee. I bet you it's high when we get to it. I would just buy those stocks. Or you might say, you just buy the Nasdaq. Another way of looking at it. So, nothing jumping out to me and going, this is a great idea. I'll say that off the bat. Right? You could just buy half of that yourself. What can we learn from this? The 30-day yield, 11.43. Well, PE ratio, 33 times earnings. There you go. Way more expensive than VU. Way more. We're currently, the lagging indicator is like 26, 27. So it's much more expensive than VU at the S&P 500. So I don't like that either. Expense ratio, dear oh dear, 0.35 because you're paying all those managers to manage it. You don't need to manage it. You could just buy those top 10 stocks yourself and just be done with it. You can manage 10 stocks, couldn't you? Just buy the Nasdaq. 0.35 expense ratio? No, I'm not paying that. I could pay 0.03. That makes no sense. 30-day yield. Okay, well, we'll look at that. You get a regular monthly payment. So if it's regularly paying you and it's increasing, it might have a point. But remember what I've always said: if you buy a stock in your Roth IRA, you can trade it for free. You can sell a stock every week, every month, every whatever to give yourself the same benefit as a dividend. The dividend only comes out of the profit that would thereby be in the gain of the stock. If you're just taking a dividend, you're just taking the profit. So you might just sell the profit and not pay the fee. These things are set up to make money for the management firm, not you. So it's just straight away, this is not a good idea for me. You can just get the S&P, you can get VU. It's a far better idea. Now, of course, it's owned by great investments. These are all good. You're not seeing Lucid and Mullen and silly stocks, right? You're not seeing all this nonsense. All good. Nothing wrong with buying this. Nothing against this at all. But I just think you can get a better result with buying the S&P. But don't take my word for it. Let's go and find out in a minute and see if I'm right. I mean, I don't know. I haven't looked at it yet. I'm doing it live on purpose, unedited, as I do it. So you can decide yourself. If you like this so far, knowing that I'm only in the S&P 500, I'm not here to pump and dump anything. I'm not sponsored by anyone. I'm just here to help people. That is it. Then, tap the like button. This is a members only live stream. I was going to say subscribe, but is there any point? Well, there is, because later on, this will be viewable by the general public later on. That's the benefit of being a member. You're seeing it live now and you can be involved in it. All right, so later on this will be available. But this is not one for me. Let's go and look now at the dividend payout. So what we're looking for, obviously it can't qualify as a dividend king, hasn't been around for more than a couple of years. But let's see if it pays out every month like it promises. Guarantee it will. It's JPMorgan, right? It's not going to promise it and not deliver. Is it going to increase? Well, I don't think so, because this is very volatile. The stocks in it are volatile, so I don't think it'll be a steady increase like the S&P, Coca-Cola, J&J. It'll be up and down, but it'll trend up. But it'll be wobbly, right? So you're not always going to know what you're going to get. So that thereby you can't really compare it, really. Let's go and have a look. Okay, so here we go. Started paying out in June 22. 37 cents. All right. 33, it dropped, then 40, then 54, 37, 68, 54, 47, 57, 44, 43, 45, 48, 35. So straight away you can see it's not always it's always paying, but it's not always increasing, is it? 23, FTSE 39, 34, 38, 43, 44, 42, 55, 55, 49, 50, 40, 45, 48. So there you go. Not always going up. This is not like a J&J or a Coca-Cola or the S&P 500. It's not. It isn't. But it's paying every month, and if you're happy with the yield, that's fine. But really, for 99% of all investors, all you need to do is compare it and see how it performs over time. And it's very simple. You don't need to calculate all those things. You don't need to make it complicated for yourself. So let's do a comparison, shall we? This is the comparison of the S&P 500 laid over the top of JPMorgan. All right? JPMorgan is in orange, and the S&P 500 is in blue. All right? So you can see the price return is 262.61. The price return 34.39 over the period that it's existed. Way ahead. Not even close. Not even close is the S&P 500, JPMorgan. So there's your first thing. Let me go to the top. So this is over the last couple since it's been inception, right? You can see the S&P in blue has massively outperformed the stock. So there you go. That's the first thing. If we look at momentum, JEPQ is D, momentum, because when tech goes down, boom, this goes down. It's got nothing to hold it up. And remember, the power of an ETF and the power and the weakness of VU is its strength. What happens when people sell tech? What do? They buy defensive. When they buy defensive, your portfolio, the ETF, stays up because VU holds the defensives. You see where I'm going? It's a no-brainer. S&P is way better than this. All right. So momentum is D, VU is B. Expenses, I just told you, it's triple, quadruple. In fact, it's way more than that, actually. It's about 10 times as much. Yes, it's 10 times as expensive. From an expense ratio, you're paying the managers actively to watch this. You don't need an actively managed fund if you're buying an ETF. You just don't. It's good for them, not good for you. B, VU is A+. Right. Dividends, A-. I love this. This is why I invest in what I invest, right? A is better than A-. Risk, B. Well, of course it is. It's mainly in one sector. It's not a good idea. It's like buying individual stocks, really. It's very, very concentrated. It's for people who really believe that tech is the only answer. B, VU, A+. It's the same for liquidity. Yes, it's bound to be. JPMorgan, no issue there. We don't need to look at that. Yes, now then, you're going to say this to me, and people who know who invest in dividend stocks, who think dividend stocks are the greatest thing in the world, are going to say to me, yes, but I get 1092 every single month. You only get 131. What do you know you're talking about? Yes, because the dividend comes out of the fees that you pay to the management company, and it comes out of the stock reduction of the stock valuation to pay you the dividends. It's not free money. And like I said, if you bought it on a Roth, you could sell it anyway and take the profit without paying tax. It's exactly the same, except you can pick when you want the money. This is going to pay you monthly on the worst day of the month or the best day of the month. Why don't you just do it yourself? You're actively paying someone to manage it. Actively pay yourself to manage it. This is lazy, free money that ain't free money. This ain't free money. This is the way to go. And if you don't believe me, we'll come on to, I've just shown you the comparison. The comparison is the conclusion of the video. It's a proof of what I just said. If you look at the performance, we do that, and that's fine. Average daily turnover technologies, yes. We know about what's in the fund, stock ideas account, yes. Yes, we don't need any of that. Okay, there we go. And we know what the expense ratio is. We've just done that. We've covered all of that. I don't think there's anything on there that I've missed that you want to know. No. Oh, there you go. Yes, there you go. 10 times as much. In fact, no, 100 times as much, isn't it? 0.03 times 10. No, 10 times as much. Beg your pardon. Move the decimal place. Yes, it'll be 0.3. 10 times as expensive. As I said, I did the calculation in my head. I just guessed it. But yeah, 10 times as much. Absolutely bonkers to do that. Unless you really think that tech's going to explode and everything else is just going to go down the toilet. But I just don't see that. And it just isn't the case, because the benefit of owning an ETF is rotate out of one sector into another. That's the power. That's the weakness and the power at the same time. So anyway, there it is. You can see the chart, how the chart is a lot more volatile when it moves down, equally when it moves up. We looked at the, I haven't done this yet. This is the back test, but this is showing you exactly what I just showed you a few moments ago. Over the periods. Right, now this is important, okay? Now, this is really important. I've just shown you how the stock performs without the dividend. Now I'm going to show you with the dividend, because what you were just looking at there at the moment, let me go back to here, was the performance of the stock without the dividend. Okay, this is the performance of the stock. Now you have to compare it to if you actually reinvest the dividend. Okay, so now we're going to go back to a back test where you do apply the dividend. Let's go back over here. So now then, it's only been around, we can only go back since 2023. So it's very, very little time. And over that period, we've seen a massive surge in, over that period, we saw Nvidia explode and so on and so forth. It's coming down now. And the S&P is broadening, and you're getting tech rotate into financials and so on and so forth, okay? So if we look at the blue is JPMorgan, and the green is in the S&P. Now you can see by reinvesting those dividends, if you reinvested those dividends, remember, you don't necessarily do, but if you did, you have just outperformed the S&P. But remember, you could have done the same thing. You could have traded at the top and bought back on the dips. The same thing. But now we've got the JPMorgan coming down faster than the S&P. So if you'd put $10,000 in JPMorgan back in 23, it's only a year and a bit, right? You'd have $17,000. Great. 10,000, and that's reinvesting the dividends. The S&P, you're down to 16,000, 1,000 less. Okay, but now we're dipping on tech, and the S&P is going to come back with the defensive because it's broadening. So what it really comes down to is this: it's very, very similar. However, if you include the expense ratio, and this doesn't show the expense ratio. Because some of you are going to say, well, you have performed better by applying the dividends as compared to the growth. Yes, you have, but there's one element you've not yet included. With a managed ETF, when you sell the ETF, when you sell the shares, you will pay a fee. And that management fee needs to be paid. Now, you don't physically pay anything. It just comes out of the sale, right? And it pays the fees. My prediction is, my guess is, looking at that chart I just showed you where you were slightly ahead on the S&P, right? You will lose nearly all that in the management fees when you come to sell. So you're back where you started. Bearing in mind, now we've got the tech rotating down, and we've got broadening of the S&P. So essentially what it comes down to is this. Is it a bad ETF? No. JPMorgan, solid. Liquidity, you can rely on it, even if JPMorgan went bust, which they're not going to. All shares you own are with custodians, just like Robinhood. You're safe. It doesn't matter. So it's not going anywhere. You can own this. It's great. It pays you a dividend, and that's great. However, you can sell on your Roth IRA, and even if you do it on your brokerage account, you do pay tax on dividends. They're not free money. It comes out of the gains of the stock. Now, if you bought back in, and you bought back in at the right time, you would then be able to outperform the S&P slightly. But then when you sell with the management fee, you'll end up about the same. Then you've got to consider, will the S&P start to outperform when tech cools? I think, as we've seen recently, the markets are broadening. So it's slow at the S&P at the moment, but I do believe the S&P is going to outperform the tech sector, the Nasdaq. So if you are really not wanting to sell and you just want manual, it's not free money, but automatic payments every month, that's absolutely fine. Then take this stock, knowing when you sell, you'll pay the fee, which will bring it back down to the S&P anyway. So there's that way, or VU anyway, at least. SPY is more expensive, but VU. If you believe that tech is not as future-proof, and you think the broadening of the market, which I do, you want protection, you can't have protection with this. Yes, I've only shown you 50% is the tech. Other part isn't tech. I get it, but it's not as defensive as the S&P 500 is. So that's what it comes down to. Do you want a payment system every month or whatever, or would you prefer just to trim off yourself as and when you want to? It's the same deal really, but you can choose when you do it rather than automatic. So if you're a passive investor that doesn't care, fair enough. When you sell it, be aware that you'll end up back where you started from because of the management fees. Is that necessary? And you're also more vulnerable to tech because you're 50% or 49% invested in tech. For me, I'd be on the S&P 500. I don't think it's in any way debatable, because these when I showed you the dividend payouts, they're not predictable. They're up and down. They're not increasing. It's not a dividend paying stock like a Coca-Cola, a J&J, an ever increasing income. It's a bit up and down, always paying, always reliable, but not always increasing. In fact, not at all. Actually, it's up and down. All right. So there it is. It's a good fund. If you like receiving regular payments, you don't want to sell yourself, it's okay. Nothing wrong with it. It's good companies. Quite honestly, if you just want these companies, just the top 10, you could just buy them yourself. Don't pay the fees. Manage it yourself. You don't really need it. I don't see a place for this portfolio other than people who just want a comfortable free ride and then pay for the privilege. It's not one for me, but it's still a good stock. I just think the S&P, or VU, the S&P is a better option. What do you think? Do you agree with me or not? Either way, it's a good stock. You're not going to go wrong with this one. I still think you're going to be very happy. Click above my head for all the links down below in the description. Over here, I shall put a playlist for JEPQ, should we ever wish to cover it again. And down here, I shall put my full playlist of all the stocks I've reviewed. It's my Alpha Spread playlist, and you can go and check that out. Until next time, as always, take care of yourselves and each other.